something. Nothing will stop that unless we go back to the Dark Ages because we've had a nuclear war. My head remains with my core framework, which has been we are still in a disinflationary world, and that interest rate rises are self-limiting because everybody's too indebted and the aging population, and that trend in bond yields I call the chart of truth, where bond yields go down over time, holds. That is currently the least popular view from most people. Still think that the demographic story is larger and that demand for commodities is driven by the economy itself. And so I know it's fiscal stimulus, but at the margin, if households spend less, then the price of commodities comes lower. I think overall, I still think commodities come lower than here. The big question for me, I think we're headed towards recession. Now, again, as ever, everyone's saying, well, this time it's different. The forward part of the twos curve doesn't suggest interest rate cuts. The 3-month, 10-year is not inverted. You know, there's always a but this time. I generally look at all the forward-looking indicators that I've been using for the last 20 years. Most of them are weakening, showing weakening growth. I don't have many things that give me a recession yet. So it kind of feels like 2006, where the yield curve remained inverted for a period of time before the actual bad news comes. It happened because of commodity prices. What we've had is a massive tightening of monetary conditions because wages have gone up 5% and inflation's gone up 7.5%. So what you've done is destroyed demand by 2.5%. So that basically, if the trend rate of growth is 2.5%, you've just gone to zero. So I see that in inventories to new orders in ISM. That relationship suggests that the economy is headed to pretty close to recession. I look at shipping, freight, all of these indicators, the year-on-year rate of change, they've all gone to recessionary levels. So something's going on. Consumer sentiment, the University of Michigan's consumer sentiment indicator is recession levels. It's consistent with the yield curve. Small business optimism, falling, not yet at recession levels. ISM new orders, falling, not yet at recession levels. The ECRI year-on-year survey, the Economic Research Cycles Institute, that is, again, pretty low, near zero. So there's a lot of indicators that are like, listen, ISM is likely to get down to between 52 and 50 between June and July, something like that. Usually the Fed stops when that happens. Housing market cooling down. So all the things you'd expect to see are happening. So, you know, I think the moment, oil's has been coming off and it's still kind of a bit sideways-ish, but if it breaks much lower than, let's say, 95, it could go back down to 80, and that takes a lot of pressure off. You know, wheat as well. I did the work on the stocks-to-use ratio of wheat, excluding China's massive stock of wheat. It's still pretty high. It's as high as it's been in the last 20 years. So as long as we don't have a terrible harvest in wheat, we're not going to run out of food. So I think that the market might have over-extrapolated the trend. And I think that if the ISM comes down to somewhere close to 50 by the summer, the Fed might have done another 50 basis points or 75 basis points, but they're going to say, well, let's just watch and wait and see. Now, we saw this playbook in 2016. The Fed were like, yeah, we're going to raise rates 4 times this year. They raised once and then didn't do anything for over a year. So let's wait and see. I think because the yield curve is later in the cycle, unlike 2016, I don't think they come back again and start raising. If they stop, they stop. Most people are expecting something much more dramatic, which is that inflation stays much higher. I don't know what that means, whether they're talking about 3%, 4%, or, you know, I would suggest that CPI stays between the 2 and 3% kind of, 1 and 3% area. So in that maybe bond yields trade sideways, but I don't see they breaking out from 3%, which would be a new high, cycle high that we've not seen before, because that's not happened in 35 years. So we'll wait and see. I mean, it's a big picture change. I mean, you know, the Russian situation is like the Arab oil embargo, so we've seen that before. But then this massive shift to ESG, which is a huge kind of global stimulus, where the ECB needs to retool the Europe needs to retool its entire economy. But we've also never had that with the largest amount of aging population of all recorded history and the largest debt load. So who the hell knows? Okay, how do you allocate money here? And that's where, well, what do you do? Short the bond market? Well, it's already pricing in 7.5 hikes. Do you want to buy commodities here? No, because it's priced in a lot. What do you want to do with the equity market? It already went down 30% and then rebound. It's really difficult to know what to do. And seasoned professionals are going, you know, I don't really know. Gold didn't do anything. It was supposed to be the Great Recession, Great Inflation thing. Well, that failed. It's been fascinating.
Cryptocurrencies are still trading, well, at least Bitcoin still seem to be trading as a risk asset.
Yeah, so what, the only sense I can make of it is NASDAQ and crypto bottomed roughly similar times. That's because they're expecting slower growth. And so that, for now, seems like a good allocation. The dollar seems that it should go higher, but it's really hard to allocate assets in this. There are times when macro doesn't matter. There's like 2013, 14, 15, it was boring as hell. And then you don't really know what the trade is because it's just owning equities and it's just, there's nothing. And then there's trades like this when everything in macro is moving. No, I can't remember a time, you know, yes, what I've done is obviously crypto, and I put out trade recommendation in Global Macro Investor based around my exponential age tech themes, because I don't believe the story that inflation is exploding further and rates will go higher. So I think the economy slows down and those things do well. But no, this is difficult. This is a really, really, really difficult market. So I don't know, but it's like this fixed cost that sits over you. So if your real income has gone down, then you don't have as much money to spend. And we've seen discretionary spending kind of falling apart in many places. I know restaurants have seen a big slowdown now already. In terms of the debt, why worry about the debt? The Federal Reserve will never allow any of this to go bust. I mean, it's a sad truth. You know, they've bought corporate bonds in the past. They've underwritten households with government checks in the past. They obviously buy the bond market. So what's going to go wrong? This is the crazy situation we're in, is you debase the currency and never allow the debtors to go bust. So you penalize everybody because everybody took on too much debt. It's crazy. Nothing will stop that unless we go back to the dark ages because we've had a nuclear war. But you know, the rise of technology in the exponential age is all of these technologies all coming together all at the same time. Now, if those things get adopted on this exponential trend, which is a logarithmic curve, then what you find is that even if you wait for a couple of years, that correction catches up with the log trend. So things become undervalued really fast. People don't really understand that. These are not cyclical plays like commodities that go up and down in big waves. These things just go up because you've got technological adoption. So nothing stops that. What we did see was a re-rating of the markets of the valuation of those businesses. So some of Cathie Wood's more further out growth bets fell 75%, but they've already fallen 75%. So I've been buying this stuff because I've got a basket of all of these things, and it hit 2 standard deviations oversold over its last 10-year trend. It's like, well, it never goes further than this, really, unless, for some reason, technology is going to go into reverse. Not going to happen. I think technology is a great bet. Does it outperform crypto, which is part of the exponential age thesis? No. But some people don't like crypto. Some people run an equity portfolio. Other people run all sorts of different things. So just so people are clear. To me, as expected in Europe, I knew that they wanted to do this on wallets. It's yet again Europe making bad decisions because they love regulation more than they love entrepreneurship. And so, you know, somebody pointed out. Look at the largest tech company in Europe. It's SAP. SAP is a company that was like a huge tech company in the late 90s. They've not developed anything because the regulatory framework is so bad. GDPR was really hard. I understand what they're trying to do, but they're creating a state that doesn't allow for innovation. And here we go, again, making it more and more difficult. Sure, I mean, do I care about KYC in my wallet? No, I don't. But it's just at the margin, just doesn't help Europe. Bitcoin, I can understand why it helps sovereign, individual security, because, the seizing of assets. I mean, what happened? These Russian oligarchs, they've taken all of their assets without due process. This is not good. Yeah. This is not good. Normally, in Western democratic nations, you would be taking them to court. You would be prosecuting them under certain things. But we're making everybody guilty until proven innocent. And what is the due process to get the assets back? That scares people. It scares people a lot. It scares people what happened in Canada. These things are an abuse of power. And again, they might be right. The truckers in Canada might have been in the wrong. They were really disrupting people in downtown. Not saying the oligarchs are good people, but Western democratic nations have a rule of law. So anyway, for individuals, it makes sense because self-sovereignty over your own money seems like it's becoming a more important issue. We've got to get from here to there. And what everyone's realizing is from here to there is a tough journey because we don't have the resources and all the lithium and stuff that we need. We don't have the supply chains to do it, so we need to figure it out. Now, is that nuclear power? But that takes 10 years to build a power station. So this is the structural inflation argument, but it depends where that inflation is. We had a commodity super cycle whilst China was coming into the global economy after 2008. After 2000, we had a commodity super cycle. We didn't have high inflation. It just depends. Nothing is written here. So if you think that growth is slowing and inflation will slow, you want to own equities and you want to own crypto, and you're fine. If you think that there's secular stagnation and that's not going to change, then you don't want to own equities. But then what do you own? I mean, gold's gone nowhere. So that's normally what the people who believe in secular stagnation be going, well, you need to own gold. Well, it hasn't really worked. It's up 5% this year. It's kind of offset equities, I guess, which are down 5% now. But it's not been easy. And commodities, the answer is I don't know. So I'll tell you what I'm doing. And I'm at a personal level, haven't changed anything. I'm still 100% crypto because I think that's the biggest secular trend of all time. On a global macro investor level, I am long dollars. I am starting to buy exponential age equities and long crypto and trying to pick the top in the bond market. And I'm still waiting. I had one shot that failed. I'll give it another go. But in terms of a broad allocation, if you've heard me speak through this whole show, the answer is it's not clear. So just don't take too much risk. And Greg and Kevin, know them both well, are at the forefront of what most people can't see. We're still talking about Bitcoin, Ethereum, Solana, and all those, and those will be important. What these guys are talking about is the applications layer, how it goes to the masses. And that is really interesting because it affects businesses like Real Vision. It's going to affect everybody, the music industry, the book publishing industry. And I've been following that narrative in Raoul's Adventures in Crypto because that is the mass adoption phase. And it's going to be huge because I'm involved in it and I see it everywhere.